All right. So, you gave us like this really in-depth look at the real estate market.
Yep.
And we're talking about like from 2006 all the way to now, it's like almost like a timeline. And that's exactly what I want to kind of like dive into with you here.
Okay.
Instead of just like the, dates and the events and stuff, I want to kind of get into the why behind it.
All right.
Like what patterns can we pull out of this? What does that mean?
Yeah.
What are those patterns telling us?
Yeah.
So we're going to be looking at everything from like, those initial like buying rushes to the big policy changes to how investors and, just like regular home buyers have reacted to all of this stuff.
Yeah.
So
it's a really fascinating period.
Yeah.
Just laid out there like that. I think what strikes me immediately is just how reactive this market has been.
Yeah.
It's not a steady climb or a consistent fall. It's almost like these series of pushes and pulls, often, quite dramatic.
Right.
In response to different pressures, both inside and outside the real estate world itself.
Exactly. And speaking of dramatic, the timeline starts us off with a bang, right?
Yes.
From 2006 to 2008, we see this incredible flurry of activity, people snapping up these booking slips, which weren't even the final property registrations, with just a tiny down payment, like 5 or 10%.
Yeah.
That really paints a picture of a market that was just on fire.
Well, and that initial surge, it suggests a market perhaps fueled more by emotion and the anticipation of quick profits than by the, fundamental value of the properties themselves.
Right.
The very low barrier to entry, that small initial outlay, likely drew in a lot of people.
Right.
Not all of whom were necessarily looking for a place to live, but rather an opportunity to make a fast buck.
Okay, so can you unpack that a little bit more? Because, we're talking about these booking slips.
Yeah.
Like, what are those exactly?
So these weren't actually property registrations.
Right.
They were more like expressions of interest or initial allocations, often carrying very little legal weight.
Okay.
The ease with which these could be bought and sold with minimal down payment fueled a speculative bubble as people were trading these rights rather than actual assets.
Okay, so let's unpack this further.
Okay.
Because what follows that initial boom is the global slowdown. But then surprisingly in 2010, we see this rapid bounce back.
Oh, wow.
Group housing launches were selling out in a month.
Yeah.
And investors were even seeing premiums within just 2 months.
Yep.
That seems like a remarkably quick turnaround.
It does indeed. And the speed of that recovery, particularly in group housing, suggests a couple of key insights, I think.
Yeah.
Firstly, global slowdown might have, temporarily sidelined many aspirational buyers who had stable incomes and were simply waiting for a more favorable moment to enter the market.
Okay.
Secondly, the relative stability of tangible assets, like real estate, during a financial crisis likely reinforced its appeal as a long-term store of value.
I see.
Especially when compared to the more volatile, stock markets at the time.
Yeah.
So this highlights a recurring theme I think we'll see.
Yeah.
In times of broader economic uncertainty, real estate can often be perceived as a safe harbor.
Interesting.
Driving demand even after, significant downturns.
Okay, so that kind of brings us then to the investor behavior between 2010 and 2013. The timeline highlights this trend of over-leveraging, where investors were booking multiple units with those same small down payments.
Right.
It sounds like some of the earlier speculative habits might have crept back in.
It certainly bore a striking resemblance to the pre-2008 boom.
Yeah.
With similar patterns of, low entry barriers and speculative activity driving the market.
Yeah.
This practice of booking multiple units with very little capital down creates a fragile system.
Right.
It operates on the assumption that prices will keep rising, allowing investors to sell before they have to make substantial payments.
Yeah.
It's a high-stakes game, and when market conditions change.
Exactly. And they did change, didn't they?
Yeah.
In 2013, the timeline points to a slowdown triggered by what's described as a liquidity crunch as those installment payments started becoming due.
Right.
The political uncertainty at the time probably didn't help things either.
Right. The liquidity crunch was almost an inevitable consequence of that over-leveraging.
Right.
Think of it like this.
Yeah.
Many investors had promised to pay larger sums of money later for these properties that they had booked. When the time came to pay, a lot of them didn't have the cash.
Yeah.
Because they couldn't sell their bookings for a profit as easily as they had hoped.
Yeah.
So this lack of available money in the market to meet these payment obligations caused a slowdown. And the political uncertainty would have added another layer of caution.
Of course.
Making both genuine buyers and speculative investors more hesitant to commit.
So the market hits this significant roadblock.
Yeah.
And that's when we see the government stepping in with the affordable housing policy around 2013-14.
Right.
What's really interesting here is the fixed rate of $4,000 per square foot.
Good.
And the lottery-based system for allocating these homes, that's a pretty direct way to intervene.
It was a very deliberate attempt to address the housing needs of a specific income segment.
Yeah.
And to inject some stability into a market that had, clearly become quite volatile.
Yeah.
So the fixed rate of $4,000 per square foot was specifically on the carpet area, which is the actual usable space within the apartment.
Right.
The distinction is important because developers often market properties based on the larger super area, which includes common areas.
Right.
So by fixing the price on the carpet area and using a lottery system, the aim was to reduce speculation and ensure that these more affordable units reached genuine end users rather than investors looking to flip them.
And the immediate impact, as the timeline notes, was quite significant.
Oh, yeah.
Investor interest in the major segments, group housing, plots, commercial, pretty much evaporated in 2013-14.
Yeah.
We also saw developers facing payment delays and channel partners leaving the industry. It sounded like a real shakeup.
It was a major recalibration, no doubt about it.
Yeah.
The policy essentially changed the rules of the game.
Right.
And the segments that had been heavily driven by investor speculation suddenly became much less appealing.
Yeah.
The delays in developer payments and the exit of channel partners are clear indicators of a significant drop in transaction volumes and overall market activity in those previously hot areas.
But while the investor side was cooling off, the timeline points to something else happening. A spike in demand for affordable housing. Those 2025 lakh 2 BHK flats, specifically from people looking to actually live in them between 2013 and 2016. It's like the market was bifurcating.
This divergence is a key insight.
Yeah.
It highlights that there was always a genuine underlying demand for housing, particularly in the more affordable price brackets. The policy, despite its dampening effect on investor activity in other segments, did seem to tap into this real need from individuals and families looking for a home, rather than just an asset to trade.
However, this period also saw a worrying trend. An erosion of buyer trust. The timeline mentions increasing legal cases against developers for delayed projects. And the rise of buyer associations taking collective action. That really underscores the risks that were prevalent for homebuyers.
Well, the lack of accountability and the sheer number of delayed projects had a devastating impact on buyer confidence. People were investing their life savings, often taking on significant debt. And not receiving the homes they were promised within the agreed timelines. So the formation of buyer associations and the increasing legal action were a direct response to this widespread frustration.
Of course.
And a clear demand for greater protection and transparency in the sector.
Which brings us to a really pivotal moment in 2017. The implementation of RERA, the Real Estate Regulatory Authority. This was designed to bring in more transparency, regulate the activities of developers, and create a system for buyers to address their grievances. It felt like a real attempt to bring some order to what had been a fairly chaotic landscape.
RER was indeed a landmark piece of legislation. It aimed to tackle many of the systemic issues that had plagued the market for years. From the lack of clear project timelines and proper financial management by developers to the absence of effective mechanisms for resolving disputes. Its implementation was intended to restore faith in the real estate sector and create a more level playing field for both developers and homebuyers.
Now, moving forward, the timeline highlights a shift triggered by the DDAJA policy in Haryana. This policy allowed for plotted development on much smaller pieces of land with smaller minimum plot sizes. And this seems to have been a catalyst for developers to move away from group housing and focus on these plotted schemes. Why was that?
Well, the beauty of the DDAJA policy from a developer's perspective was the lower upfront investment required for land acquisition. Smaller land parcels meant less capital tied up initially and the faster turnaround time for plotted developments compared to, multi-year group housing projects.
Right.
Significantly improved cash flow.
Right.
And reduced holding costs.
I see.
Plus, the smaller plot sizes made it accessible to a wider range of potential buyers.
Right.
It was a less capital-intensive and potentially quicker route to realizing profits.
And the investors followed that shift, didn't they?
Oh, yeah.
Between 2018 and 2021, we see a lot of investor interest moving towards these plotted developments.
Right.
Likely attracted by that lower construction risk.
Yeah.
And those faster delivery timelines, often just 12 to 18 months.
Yeah. Plotted developments offered several compelling advantages for investors.
Yeah.
The risk of construction delays, which had been a major headache and a source of uncertainty with group housing projects, was substantially reduced.
Yeah.
The quicker completion times meant a faster potential return on investment.
Right.
It was a more straightforward and less complex proposition compared to navigating the intricacies of large multi-unit projects.
And then, of course, we can't talk about this period without mentioning the massive impact of COVID-19 starting in 2020.
Right.
The timeline points to an increased demand for independent living.
Yeah.
Which makes sense given the health concerns and restrictions.
Sure.
Interestingly, it also notes a difference in how different groups of investors behaved, with professionals being more cautious, while business owners seem to be driving the investment in plots.
Well, the pandemic undeniably had a profound impact on housing preferences.
Oh, yeah.
The desire for more personal space and greater control over one's living environment fuel the demand for independent homes and consequently land.
Yeah.
The differing investment behaviors likely reflect the varying levels of economic security and risk appetite. During that uncertain period, business owners, perhaps with more readily available capital or longer-term investment horizon, saw opportunities in land. While salaried professionals might have been more concerned about job security and income stability.
And the timeline also mentions that ready-to-move-in properties gained a lot of traction during the pandemic.
Oh, yeah.
That makes perfect sense, doesn't it?
Oh, yeah.
People wanted immediate and safe housing solutions?
Absolutely. With all the uncertainties surrounding construction timelines due to lockdowns and labor shortages, and the understandable desire for immediate occupancy during a health crisis, ready-to-move-in properties became a much more attractive and less risky option for many buyers. It eliminated the waiting period and the potential for project delays, offering immediate security and stability.
What's particularly striking about this COVID period is the incredible appreciation in plot prices, 200 to 400% in some areas between 2020 and 2022.
Wow.
That's a phenomenal jump.
Yeah.
Driven by what the timeline describes as pent-up demand.
Right.
What were the specific factors behind such a dramatic increase? Was it purely about the desire for space?
That kind of exponential price appreciation really underscores the intensity of the demand for plots during that unique period.
Right.
It wasn't solely about the desire for more space, although that was certainly a significant factor.
Right.
You also had people reevaluating their priorities. Perhaps wanting to move away from dense urban areas. Additionally, with other investment avenues facing uncertainty, land might have been perceived as a safer and more tangible asset.
Right.
Low interest rates at the time also made borrowing cheaper, further fueling demand. It was a confluence of factors that created this surge.
Now, as we move past the peak of the pandemic, the market seems to have shifted gears again. The timeline notes that the supply of plotted inventories started to become saturated, leading developers to go back to launching floors, and then eventually group housing projects. It's like the pendulum swung back.
Precisely. Markets rarely sustain such extreme trends indefinitely, as the pent-up demand for plots was met. And the margins in that segment perhaps started to normalize, or even compress due to increased competition and land costs. Developers naturally look for the next opportunity to cater to the ongoing housing needs. And multi-unit housing, once again, became a focus.
And this leads us to a really significant point. The dramatic increase we've seen in raw land costs. The timeline highlights a jump from 7 or 8 crore per acre in 2020 to a staggering 45 crore per acre by 2024.
Oh my gosh.
That's a massive escalation. What's driving that?
That exponential rise in land costs has profound implications for the entire real estate development ecosystem.
Yeah.
It's being driven by a combination of factors.
Okay.
Firstly, the increased developer activity we've just discussed creates more demand for land.
Okay.
Secondly, landowners seeing this heightened demand and the rising property prices are naturally increasing their asking prices.
Right.
And finally, there might be speculation in the land market itself, with investors buying and holding land in anticipation of further price increases. This surge in land costs ultimately increases the initial capital outlay for developers and inevitably impacts the pricing of the final product for consumers.
The timeline even mentions government authorities auctioning off previously overlooked land pockets at these inflated prices with active participation from developers. It seems like everyone recognizes the value and the cost of land in this market now.
It certainly indicates a strong belief among developers in the continued demand for real estate, even at these significantly higher land acquisition costs. Their willingness to actively participate in these auctions suggests they are confident in their ability to develop these land parcels and sell the resulting properties at prices that justify their investment.
And that brings us to the recent boom in under-construction group housing projects in 2023-2024. The timeline notes that these are selling out quickly, and it attributes this to salaried buyers experiencing FOMO, the fear of missing out, perhaps after seeing the price appreciation in plots and wanting to get into the market.
The psychology of FOMO can be a very powerful driver in real estate markets. Buyers who might have hesitated earlier or focused on different types of properties may now feel a sense of urgency to enter the market before prices climb even further or perceived opportunities disappear. The quick sellouts suggest a renewed confidence and perhaps a sense of urgency among this segment of buyers, fueled by the price movements they've observed in other parts of the market.
The timeline also mentions a relaxation of the TOD policy. Allowing group housing on much smaller land parcels, even 2-3 acres. How might that influence the market going forward?
Loosening the restrictions on land size for group housing projects in transit-oriented zones can certainly make more land potentially available for development. This could lead to an increase in the supply of these types of projects. Particularly in well-connected urban areas, and cater to the ongoing demand for multi-unit housing, while potentially making it more feasible for smaller developers to participate.
Now, looking back at this entire journey, the timeline highlights some really key observations about investor behavior. The fundamental desire to buy low and sell high remains. But crucially, it points out that not every property yields a positive return. It stresses the importance of deeply understanding the specific micro market you're investing in and the dangers of letting emotions drive decisions rather than relying on data. These are valuable lessons for anyone considering real estate.
Absolutely. Those are foundational principles of sound real estate investing. A thorough understanding of the specific dynamics of a particular location, including factors like infrastructure development, employment opportunities, and rental yields, is essential. Analyzing data on price trends, supply and demand, and historical performance is crucial for making informed decisions. And keeping emotions out of the equation can prevent costly mistakes driven by fear or greed.
And that leads us to the current sentiment among buyers. The timeline notes that many are now willing to pay significantly more per square foot. $20,000, $25,000. Based on the success stories they've seen in the recent past. A huge jump from the reluctance to pay even $5,000, $6,000 back in 2020. That's a remarkable shift in expectations and perceived value.
That shift in buyer sentiment really reflects the rapid price appreciation we've witnessed in recent years. And the now perhaps ingrained perception that real estate can deliver substantial and quick returns. However, it's absolutely crucial for buyers to remember that past performance is not necessarily indicative of future results.
Exactly.
The market dynamics that led to those past gains may not be the same moving forward.
The timeline concludes by emphasizing the absolute need for professional guidance and thorough due diligence when selecting group housing projects today. It frames real estate investment as a science based on numbers and a well-thought-out location strategy, rather than just personal preference or gut feeling. That's a really critical takeaway for anyone thinking of buying property right now.
Precisely. in a market that has experienced such rapid and significant changes.
Yeah.
With substantial price increases and evolving trends.
Yeah.
Thorough research seeking expert advice from qualified professionals and adopting a disciplined analytical approach are more important than ever before to ensure informed and prudent investment decisions.
So as we wrap up this deep dive into the real estate market timeline you so helpfully provided, a few really significant themes emerge.
Yeah.
We've seen this constant cyclical movement from those early speculative booms to periods of sharp correction.
Yeah.
And then new phases of growth driven by different factors.
Right.
The impact of government policies has been undeniable in shaping the direction of the market.
Yeah.
And the ever-shifting psychology of both investors and everyday homebuyers, that interplay of enthusiasm, caution, and even FOMO has played a crucial role in driving these trends.
What's also particularly striking is the way the market seems to have evolved.
Right.
In the earlier years, it appeared to be heavily influenced by investor speculation and relatively easy credit.
Yeah.
Today, while investment still plays a role, we're seeing a greater emphasis on end-user demand and a more significant regulatory framework.
Yeah.
However, the recent surge in land costs and the renewed interest in under-construction projects suggests that the market continues to be dynamic and potentially volatile.
And the crucial importance of understanding those very specific local market conditions, those micro-market dynamics really can't be overstated.
No.
What's happening in one area might be completely different in another.
Yeah.
And a general overview of the broader market just isn't enough to make informed decisions.
Right.
We've definitely moved from a phase that seemed primarily driven by investor sentiment
Yeah.
to one where careful analysis of fundamentals and a deep understanding of local factors are increasingly critical for success, whether you're an investor or a homeowner.
Indeed, the days of, perhaps simply buying a property and expecting guaranteed high returns with minimal effort seem to be behind us.
Yeah.
Or at least much less certain.
Yeah.
A more nuanced and informed approach, focusing on long-term value and sustainable growth, is likely to be much more rewarding in the current environment.
So here's a final thought for you to consider.
Okay.
Building on everything we've discussed,
Yeah.
given these dramatic and rapid increases we've seen in raw land prices, coupled with this current wave of FOMO and renewed enthusiasm for under-construction group housing, what unexpected factors? Perhaps shifts in the broader economy, further regulatory changes we can't foresee, or even evolving preferences in how people want to live might ultimately shape the next chapter of this ever-fascinating real estate market. It's definitely something to keep a very close watch on.
Yeah.
Well, thanks for helping break down this timeline for us today.
Oh, you're welcome. It was my pleasure.
I think our listeners got a lot out of it.
Good. I hope so.
All right. We'll see you next time.
Sounds good.